of assets, impairment of assets, and that is under the purview of IAS 36, that is International Accounting Standard 36. I urge you, if you're an accountant or an aspiring one, to have a rock-solid knowledge of standards. Lawyers know the Constitution like the back of their hand. That is what determines a good lawyer. So if you're an accountant, you must know your standards like the back of your hand too. You must know standards, you must know gaps, that is generally accepted accounting principles. You must know concepts of accounting. This is what makes you a good accountant. Okay, so we'll talk about the International Accounting Standard 36. I'm interested in this topic very much because my dissertation, my PhD dissertation topic is actually about impairment of assets in Nigeria. Good. Now, I want us to understand what impairment is and how it is recognized and how it is treated, basically. Now, what is impairment? Impairment of assets. I'm not talking about financial assets. I'm talking about assets that are under the purview of IAS 36. Now, the impairment of an asset is when the carrying amount of an asset exceeds or is bigger than the recoverable amount of that asset. These are big words, right? What do we mean by carrying amount? The carrying amount of an asset, which you can also call the net book value of that asset, is when you look at the acquisition cost of an asset or the historical cost of that asset, and then you less the accumulated depreciation of that asset to date. Then what you have is what we call the carrying amount or the net book value. But I want us to stick to calling it the carrying amount because that is what is used by the International Accounting Standards Board. So, if you bought an asset 50 years ago and you are removing depreciation every year, the accumulated depreciation, when you remove it from the cost that you bought that asset, which is the historical cost, or which is also the acquisition cost of that asset, then what you have is what we call the carrying amount of that asset. So on the one hand, you have the carrying amount of the asset. Then you are going to look at the recoverable amount of that asset. Now, what do we mean by recoverable amount? That is another big phrase. Recoverable amount of an asset refers to the higher of two things. One, the value in use of that asset and the fair value less cost to sell. Now, let's look at those two things one after the other before we know the higher of the two. It's the higher of the two that becomes our recoverable amount. The first one is the value in use. The value in use is simply the present value of that asset. Okay? The present value of the future cash flows. The present value of future cash flows. How do you get the present value of future cash flows? You're expecting cash flows of maybe next 5 years running into different amounts. Now, if you discount the fair value, if you discount the value, that's the future value of those cash flows, if you discount it to the present value, what you have is what we call the present value of future cash flows. And that is done by a formula. Of course, we all know the formula for discounting, which is 1 all over 1 plus r raised to power n. So when you discount it, then you have what we call the value in use. Why do we need to discount? Why do we need to know the present value of future cash flows? We need to do this because of the time value of money, which says 1 naira today is more than 1 naira tomorrow. So if you don't discount the cash flows that you are expecting in future years to the present value, you cannot determine the value in use of that amount. Good. Now, so when you get the value in use of the asset, the next thing you need to do is also to compare it with the fair value less cost to sell. Some authors will call it the net selling price. It is also correct. You either call it the fair value less cost to sell, or you just call it the net selling price. Now, the fair value of an asset, I said fair value less cost to sell. What is the fair value of an asset? Which we already explained in our previous lecture. You can go back and watch it. The fair value of an asset is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Now, this is what the fair value is. So when you get the fair value, then you less the cost to sell it. These are associated costs. These are costs that can be directly traceable to the selling of that asset, okay, to the fair value of the asset. So when you remove when you remove the cost to sell, it could be advertisement costs, it could be transportation costs. All these are associated costs. When you remove it from the amount that we have defined, then you have what we call the fair value less cost to sell. That's fair, or you can also call it the cost. Fair value less cost of disposal, basically. Fair value less cost of disposal. When you have that, then you can now compare that with the value in use of the asset. So the higher of the two becomes your recoverable amount. So when you have the recoverable amount on one side and you have the carrying amount on the other side, you can now say carrying amount less recoverable amount or value. And then if you have a positive amount, that becomes your impairment loss. It means the carrying amount is more than the recoverable amount. So you have what we call an impairment loss. Somebody asked me that, what if you subtract, that's the carrying amount, less the recoverable amount, and you have a negative figure? What does it mean? Does it mean an impairment gain? And I said, no. It means there is no impairment. It means the asset is not impaired. It doesn't mean an impairment gain. There's nothing like an impairment gain. You have an impairment loss, and when the recoverable amount is more than the carrying amount, then it means that there is no impairment loss. There's no impairment at all. Now, the standard also encourages, actually mandates firms to carry out a test for impairment. Before you do this, you carry out a test for impairment. So there are external factors you look at. You can look at factors like economic decline. These are, you look at economic decline, or you can look at adverse market conditions. All these are external indicators that an asset may be impaired, and there are so many of them. You can read them up. So when you look at all of this, it shows you, it's indicative that that asset may be impaired. So you may need to go and carry out the impairment test proper. So if there are indications that show that the asset could be impaired, then you need to go and carry out an impairment test. Also, there are internal factors that you need to, that could indicate that an asset is impaired. What are these ones? It could be like physical damage. You could just see a machine, and the machine, there's a scratch on it, or maybe one of the parts looks physically broken. These are physical damage. It means it's an internal indication that the asset is impaired. Another internal indication of impairment could be obsolescence. Obsolescence. What is obsolescence? We are looking at a situation where you have a machine, the machine looks brand new, everything looks very clean, it's working very well, but technology has brought about a newer machine, a machine that is faster, that has more capacity, that is more efficient, more effective, everything. So it means people will no longer patronize the purchase of that machine. So we can say that obsolescence have come in. So basically, this is what the concept of impairment is. And how is impairment treated? When you have an impairment loss, what do you do with it? An impairment loss is treated, is an expense, so it is treated in the statement of profit or loss and other comprehensive income. So it is stated in your, it is treated in your income statement, except where the asset is revalued. Remember that IAS 16, that is PPE, property, plant and machinery, property, plant and equipment, actually talks about the revaluation. There are two models that are presented to us. You can use the cost model, and you can also use the revaluation model. So when you revalue the asset, then it means that impairment loss will not affect it. Also, there is also a condition for reversal of impairment loss. Yes, when the recoverable amount of the asset increases, then you may have to do a reversal of the impairment loss that has been treated in the income statement. So this will be a subject of another class, because we want to keep it simple, we want to keep it short. So we're going to stop here. If you enjoy this class, we want you to keep a date with us tomorrow, so we'll bring you something else. Don't forget to like, to share, and of course to subscribe to our YouTube channel. Check out for Accounting and Finance Coach. For now, peace and love.